Hello, and welcome to Due Diligence Investor. My name is Matthew Phelps, and this is my corner of the internet where I make detailed investment product reviews, performing your investing homework for you so that you can make better informed decisions faster. Today, we're going to be looking at XIU, the iShares S&P TSX 60 Index ETF. It's an inexpensive way of gaining exposure to the Canadian market, and by the end of this video, you will be an informed investor and will know whether XIU should hold a place inside of your portfolio or not. And if this is your first time here, welcome. You don't need to take notes. Everything is neatly curated for you on my website, which is linked below. So, XIU is a historic ETF. It originally started trading on March 9th, 1990 as the TIPS, Toronto 35 Index Participation Fund. That's 3 years before the SPY, the Spider's S&P 500 ETF, launched. Now, it's been merged a couple times and it's been bought out, but it still exists in its original format. Special thanks to Deborah Fuhr of ETFGI.com for compiling this beautiful article we're looking at right now. And to summarize, it's a collector's item. It's been around forever, and if you consider yourself a collector of investment vehicles, this is a cool one to add to your collection. Now, on a 5, 10, and 20-year timeline, it has slightly outperformed the broader core S&P TSX capped composite index. We're going to use this one as a comparison against, as it is a much broader index of the Canadian market. Now, it is also the largest and most liquid ETF in Canada, and with an MER of 18 basis points, it's an inexpensive, easy, and very popular way to gain exposure to the Canadian market. So, who would be interested in owning a fund like this? Well, I'd put 3 people really down for it. Investors looking for an easy and inexpensive way to express a view on the Canadian market. So if you want to look at Canada as a whole and you think that it's a good time to invest in, this is an excellent and very liquid way of doing so. Collectors, as I mentioned before, just looking to own a little piece of history, as well as speculators and options traders. This is a very liquid ETF, and it's an excellent way of trading on the TSX. So the strategy that this fund employs, as BlackRock describe it themselves on their website and their ETF fact sheet, the ETF seeks to provide long-term capital growth by replicating the performance of the S&P TSX index, net of expenses. The ETF will primarily invest in Canadian equity securities. The index is comprised of 60 of the largest and most liquid constituents of the S&P Composite Index. All right. So what is that in plain English? Well, each unit is a replica of the S&P TSX 60. This allows the fund to provide returns of the largest and most liquid companies on the Canadian market while minimizing their costs. Okay, so S&P TSX 60. Keep saying that phrase. What is that index? What does that actually mean? Well, in simple terms, it represents leading companies in leading industries in the Canadian component of the S&P Global 1200, providing a cost-effective and easy way to achieve equity exposure. So S&P explain this beautifully in their literature. I'm taking this from their S&P's TSX 60 methodology. It's a subset of the S&P TSX Composite, which is going to be our comparison against. It has 60 constituents and represents Canadian large cap securities with the sector balance of the S&P TSX 60 Composite. Okay, so let's break that down a little bit better. So we're going to start with all securities in the S&P TSX Composite Index, all of the common stocks available. We're going to start selecting among the largest securities, though we might modify for size for sector balancing. Secondly, we're going to select among the most liquid securities. So not only are large securities important, but liquidity. Their how often are they traded and sold? That's important as well. Although this may be overridden for sector balancing. So having an equal sector balance is important. Select securities to achieve a sector balance that reflects the much larger S&P TSX Composite Index. So that's what we meant by the sector balancing talking about earlier. We want the largest and most liquid companies in Canada that represent a good balance of the Canadian sector exposure of the Canadian market. And finally, minimum turnover is preferable. So as soon as a company makes it into the index, we prefer not to move it out of the index. It should stay there for as long as possible. So essentially, largest companies in Canada, highly traded and balanced according to market sector, with as few changes as possible. So now we know what the index is and what it strives to do. Let's take a look at what it is currently holding. And well, a good representation of its holdings would be the top 10. As we can see, they account for over 45% of the NAV. Now, I have included two companies in the top 10 spot, that is Suncor and Brookfield, because they are immediately recognizable to anyone familiar with the Toronto stock market. But essentially, we're looking at banks, energy, and pipelines, and a little bit of railways and Shopify to represent the e-commerce sector. But because of the long history of the fund and its goal of minimizing turnover and its purposeful sector weighting, a look back and comparison of the historical holdings of the fund would be helpful. So here we have the top 10 weighted from 2023 and way back to 1998. So the top five of these holdings are going to be there since the beginning. We have the Royal Bank of Canada, we have Toronto Dominion Bank, we have the Bank of Nova Scotia, and the Bank of Montreal. They've all been there since the beginning, as well as Canadian Pacific Kansas City. That was originally called Canadian Pacific back then. Looking at the holdings now, as I mentioned, Shopify not even founded until 2006. We also have Enbridge and Brookfield appearing in the top 10 now. These, they were in the original index, but from 1998, but they have grown to be included in the top 10. Whereas Bell Canada, which used to be number 1 back in 1998, it's fallen. It's still in the index, but I believe it's number 15 or so. Taking a look at the sector balancing, we see that financials have remained the largest sector overwhelmingly, briefly surpassed by technology in the dot-com bubble of 1999 to 2000. Now, energy has also increased its weight, though it's extremely volatile industry and the weighting will fluctuate with the price of oil and gas, expected to. And finally, communication services have seen a very large reduction, showing the advancement and adaptation of technology. A good demonstration of why passive investors are much safer relying on indexing rather than direct exposure. All right, let's talk about dividends. So, XIU pays a quarterly distribution. It's going to fluctuate wildly, though, depending on what the fund's current composition is, depending on the sector balance. So we do see over the past 10 years a general upwards trend. However, this would not be a suitable investment for anyone relying on income from this fund. Now, as for taxes, as expected, we'd see the overwhelming amount coming from the eligible dividends of the fund, or of the holdings of the fund itself, with the rest basically coming from capital gains or return of capital. This is going to be from the rebalancing of the fund. However, remember, one of the main tenets of the strategy is to minimize turnover. So really, we're going to see most of it coming from eligible dividends. Yeah, this is not I would not say this is a suitable investment for dividend investors, because the fund's composition will change depending on the sector balance. You should seek out a fund that is focused on the dividends and dividend growth for your needs. It's a great piece of history and is great at what it does, but it is not good for dividend investors. So now we know what the index's stratagem is. Let's take a look at how it's actually performed. And as we can see, it's about 7%. That's both on a 10-year timeline as well as since inception. The inception date being when BlackRock took over this fund, which was September 28th, 1999. This has outperformed owning the entire Canadian stock index, so an easy visualization is to compare XIU against XIC, the iShares Core S&P TSX Capped Composite Index ETF. It's also a very, very long-running index and is essentially owning the entire Canadian stock market. So we have XIU, the fund we're talking about, which is the largest and most liquid 60 companies on the Toronto stock market, versus XIC, which is the entire Toronto stock market. Let's take a look at their returns. So had you hypothetically invested $10,000 into each of these, XIU has outperformed, dropping in 10 grand 5 years ago. You see, we'd be up about $200, just under $200 into XIU. On a 10-year timeline, XIU outperforming, these returns are going to be amplified. So $750 about, difference in returns just from picking XIU instead of XIC. Impressive. This is a very long-running fund though. Let's go kick it back to 20 years. So hypothetically, investing $10,000 into the XIC, owning the entire Toronto stock market, on Halloween of 2003, you would now have $42,100. It's impressive returns. That is very, very good. However, had you chosen XIU to invest your $10,000 into on Halloween of 2003, you would now have $43,900. So that's just over $1,800 difference. Now, this is extremely impressive returns and a credit to the index, especially considering XIC's considerably lower management expense ratio of 6 basis points. As with all pure equity ETFs, there is quite a bit of volatility. The fund has dropped in value 3 of its last 10 years, giving it a risk rating of medium. This ETF is only for investors who can handle the ups and downs of the stock market and are seeking long-term capital appreciation. So, speaking of expenses, XIU has a management fee of 18 basis points. This is on the medium end of the spectrum, a little bit high for a large, broad-based index, however comparable to other funds available, and considering that XIU is one of the largest and most liquid ETFs in Canada, with a market cap of over 11 billion and a trading volume approaching 5 million, it's hard to imagine any trouble getting in or out at any time, regardless of market conditions. Okay, so now we've looked at XIU in depth, let's just briefly mention some alternatives that you might also be interested in. As far as long-term investments go, there's 2 to mention. Vanguard has their own answer to this called VCE, the FTSE Canada Index. It's diversified exposure to Canada's large and mid-cap companies. It's basically identical, perfect for Vanguard fanboys. And there's HXT. This is an interesting ETF that tracks the same index at a lower cost using total return swaps, meaning it gives the total return of the index without paying a dividend. The dividend will be perfectly reinvested and allows you to defer capital gains tax. Perfect for a cash or a margin account. Speaking of, there are trading investments for anyone, trading instruments rather, for anyone with an insight into the market or would like to gamble. It is very, very easy to get the returns of the S&P TSX either inversely correlated or double correlated. as an income investment, their Evolve has based their ETSX fund off of the S&P TSX for enhanced yield. They write covered calls on up to a third of the fund. It does provide some current income. It is a very expensive way of getting current income. It does act as a long-term hedge, although a brief reminder that income investing does not give you more income. And leveraged investments. CAN-L. So the fund employs leverage to provide 125% exposure to the S&P TSX, resulting in much larger gains or losses relative to the index. Again, if you have an insight into the market, this would be perhaps a good way of getting in. The biggest takeaway from all of that talking is that there's quite a large selection of investments. Clearly, there are many fund managers desperate to cater to whatever your individual needs may be. Okay, so now that we've looked at XIU in detail, what do I actually think of it, and what should you as an investor take away from this presentation? Well, I personally own one share of this ETF as I consider it a collector's item, and any collector of investment vehicles should have this small piece of history inside of their collection. I also think that if you're a trader, this is a fantastic way to get exposure to the Canadian market, whether you're a theta gang strategist or a swing trader. With options available, high liquidity, decent volatility, this is an excellent solution for you. Now, for long-term investors and buy and hold forever investors looking to express a view on Canada's large and medium caps, simply due to the fees incurred, you may want to look at an alternative and look at how that would fit into your portfolio instead. Sources. Some people that I'd just like to thank and where I got the information from. First up, BlackRock Canada. Thank you so much for running the fund. You also do a fantastic job of collating the information on your website. TMX Money, you are the pulse of the Toronto stock market, and I use your website every day. ETFGI, thank you so much for putting together that excellent history that I read at the beginning of this fund. Sean Freer and Michael Orzano, I'd like to thank you two gentlemen specifically. You wrote an article called Reflecting on 25 Years of the S&P TSX Index Series. It's linked on my website with all the other links necessary, or all the other source information. They did a fantastic job compiling the information, and it was a super interesting read. And speaking of these two gentlemen, I just want to thank the S&P Global in general. Really interesting work with your S&P methodologies, and I've learned a lot about investing from the work that you do there. And finally, thank you for watching to the end of the video. I really appreciate your interest, and I hope that this has been of use to you. If you'd like your investing homework done for you, then you can either get my research notes, which are coming out soon. It's a very, very simplified version and just gives you the answer about possibly where you should invest your money. Or you could get a direct consultation. A surprising amount of people want to chat with me, but I don't read YouTube comments, and my time is extremely valuable. So I can either give you an email or a video response, or if you'd like to book on a one-on-one consultation, I'm happy to do so as well. Thanks so much for watching, everyone. You're doing a great job right now. Keep investing your money and everything is going to be okay. Bye for now, and I'll catch you soon. Cheers.
Once again, this is rumor control. Here are the facts.